Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the current economic uncertainty and what path the Fed will take this week to address that. First, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast. And for those of you who are watching, so we know that we do have a good number of people who watch this as opposed to just listening. Your hair is crazy. And tell me why you showed up with your hair like that.
We're talking about what will the Fed do next. And, this is Friday morning. We just got the Michigan Consumer Sentiment Index. If I took it at face value, that was the worst report I've ever seen in history. So in a chaotic time like my hair right now, right? What does the Fed do? Because in chaos, some people love to be more focused, but some people are prone to doing mistakes. So when I am in a chaotic situation, I tend to do better work because I don't let things, change my model too much. But the Federal Reserve is probably more at risk of maybe doing a policy mistake if they take all the survey data or all the interpretations of what the marketplace is saying to us. So the Michigan Consumer Sentiment Index had a vertical move up higher in inflation expectations. Now, in theory, the Fed would have to actually raise rates right now to offset that. You want to anchor inflation expectations. However, the employment data had a waterfall collapse as well, like, what people think. So that on the dual mandate side, what do you pick, right? It's basically, you're doing a AKA dual mandate shootout now. Who do you choose? Do you choose the gun for employment or choose the gun for inflation? So it's going to be very interesting. I encourage everyone to make sure to kind of listen to what the Fed talks about, or we'll go over it. But how they act this year will be very relevant for not only this year, but next year in terms of, do they make a policy mistake by reading too much into one of these data lines? Because on one hand, you should be cutting rates. On the other hand, you should be raising rates.
Right.
The Fed has been a little bit more stable in terms of not reacting to one data point or one inflation report or anything like that. But there's so much noise now. And they raised their inflation expectations in 2025. That's one of the reasons I believe the 10-year yield even went up earlier. So it's chaos, right? This is concentrated economic chaos. And in this environment, you're more prone to make a policy mistake because you might react to something a little bit too aggressively to the up or downside.
So, in the midst of this, we also have an administration that really is focused on housing and specifically the case for lower mortgage rates. They want to make housing more affordable. That's something, they don't have direct control over interest rates, over mortgage rates, but they've made it clear. We have a new FHFA director, Bill Pulte, was confirmed. And his first evening on Twitter after being confirmed, he made sure to say, rates are falling, or that he's very focused on, GSE exit, but also rates. And then he said, rates have fallen for the last, was it 6 weeks? Logan, that he said?
Due to President Trump.
Right. So I know that they're eager to so how does that work into this? I know that the Fed is supposed to be independent. I believe they've tried to stay out of the fray. But when you're talking about inflation, aren't you also talking about mortgage rates?
Here's the thing. We had lower mortgage rates when the growth rate of inflation was higher. So Fed policy is really 65 to 75%. And the reason I'm harping on this is that I didn't do a good enough job in the past of kind of making that the vocal, where the Fed can control things. And if the Fed wanted to lower mortgage rates, it can. A lot of people say they can easily do it. But the Fed right now, their Fed funds rate is obviously above the growth rate of inflation of PCE. Right. We had the inflation reports. We're still going to have a 2 handle on all the PCE inflation. So they believe they are still restrictive. In that context, they could just stay put until they see the labor market break. Some people say, well, the growth rate of inflation has to take off. In the 21st century, we have never had PCE inflation above 3.5% outside of global pandemic. And that was a very short inflationary spike and a disinflation spike. We've never been able to pull it off. We've had zero interest rate policy, QE1, QE2, QE3, Operation Twist, deficit spending. Never could get it. Never could get inflation up there. So the question I think the Fed must be asking themselves, can a global trade war create inflation to bring PCE inflation, the growth rate on a 12-month basis above 3.5%, which gives them a little bit less restrictive policy, and can they just stay there? I think that's the complicated question for themselves. I think half of the Fed is very mindful of tariffs and half of the Fed doesn't care. So there's going to be an interesting divergence between some of the presidents. And that matters a lot for housing in that regard. So you can create a lot of chaos, stocks selling off, bonds going down. There's a lot of Wall Street economists have already lowered growth, but that was the whole game plan. We want to lower aggregate demand and create higher labor supply. I think JP Morgan came out and said, well, we're raising the unemployment rate to 4.4%. We lowered our job growth down to just about above 100,000 per month. And we basically say the unemployment rate will get to 4.4%. Under that model, the 10-year yield has room to go down if that occurs. Because once you get above 4.3%, then the Fed say, unless they change this, right? And I think that's the thing. Do they change it to say, we're going to be a little bit more mindful of inflation, because inflation expectations are taking off, but it just gets more in chaos. You're prone to make mistakes. So it'll be interesting to me to see how the Fed reacts to everything, right? Everything we have just seen in the last 6 weeks. A lot has changed since the last time they had their meeting.
So, you've said here on this podcast, you've said in, on your socials and our Slack, and to me, you've said, yeah, the 10-year yield looks about right to me for what's going on. I don't know that. I mean, I think, the expectation that mortgage rates would go down more with some of these things happening is what people thought. So maybe explain why you think it looks about right.
So if you look at the labor data, remember, I'm a paper, rock, scissors, labor over inflation. If we didn't had the trade war tap dance or all this craziness, we would be saying the labor data firmed, job growth firmed. It's in my forecast range. The job openings data firmed up a little bit, and the jobless claims data came down. So if I just took the labor data, the 10-year yield looks about right. Nothing abnormal. The growth scare of what the trade war tap dance did and the selling of stocks brought the 10-year yield lower. And we're already seeing people revise estimates, and we've seen the White House even talk about, there could be a hit early on. So the 10-year yield is where Fed policy looks about right. We got to a key technical level. We bounced off of it. And we have these waves and channels every single year since 2022. This is why when I forecast, I do channels with a 10-year yield based on Fed policy and where the economy is. I don't mortgage rate target. Sarah, if I ever do one of those things, please,
I know what you're going to say.
Just take a gun and shoot me and just end my life. I just cannot. I've never understand that concept because of the slowdown.
Usually you tell me to take a knife and knife you in the thigh and throw you to hyenas.
No. If my ultimate talk is shoot me in the thigh and let me die by having a pack of hyenas eat me alive slowly and intimately. Yeah. So basically that I as somebody who just talks about the slow dance and everything, and I just do 10-year channels and rates, and they move with each other. And this has been happening since 1971. There's so much emphasis on mortgage-backed securities, but the spreads are 1 to 1.25 difference. It's really Fed policy. That's why I encourage everyone, go look at the chart of the 10-year yield and 30-year mortgage rates since 1971. And it's a lovely slow dance. Sometimes they're close, right? The spreads are good. It's a very intimate slow dance. Sometimes the slow dance is very bad, like junior high or Footloose, something like that. But it looks about right considering what's happening. Now, if the jobs report, let's say Jobs Friday came in at 54,000, wage growth slowed down, hours worked went even lower. Job openings data is 6.2 million instead of near 8 million. Hires and quits and everything fell down. And then the jobless claims is at 278,000, didn't come back down to like the 220 area. Oh, 10-year yield. Bam! We are cracking through that 418 level easily. But that didn't happen. So for now, everything looks like it's now going in the rest of this year, because we try to format this on the unemployment rate. If government job workers slow and go negative, that means the total employment level goes lower. If the labor force stays constant or grows, the unemployment rate can go up. And the policy mistake that I think the Fed could make is saying that, well, if the unemployment rate goes to 4.3% or higher now, we don't care because we're focused on inflation from tariffs. Okay, that is something that they can say in the next meeting. That's why I'm very, very mindful of this. And again, in chaos, this stuff like this happens until you get a little bit more clarity.
Okay, so if from your perspective, if that is something they do and that's a mistake, then what's the outcome there?
The outcome is what the Fed wrote about in 2018. If they chase a tariff trade war by raising rates, it's most likely they'll send the economy into a recession. And then what that happens is that you're going to get everyone, hey, the Fed raised rates, a recession, bond yields have to go down and rates have to go down. So that's why I'm not like, I don't believe in like in a 1970s stagflation where, you need a supply shock. We did a podcast on that. We try to model out like what has to happen to get that. But in the short term, you're more prone to an accident.
So I know that we talked about 1970s style inflation, why that's not the case, but that was like a year ago. Let's revisit a little bit of that now, because I hear the term stagflation all the time now in a way that I didn't even a year ago. So maybe explain to the youngsters out there what stagflation is if they didn't live through it the first time, and why you don't think we're there now.
Well, the best way for me to explain stagflation to everybody listening, because mostly everyone here is real estate and mortgage, the U.S. housing market right now, prices are rising, but sales are at the lowest levels ever, right? So if you think about stagflation, is inflation stays higher than what you want, but growth slows down. So we have that in housing. It's the growth rate of pricing has slowed down a lot, so that's a positive. But in a stagflation, you have the inflation takes off, growth slows down, you get a recession, and you don't have like the benefits of the 10-year yield falling, because back in the mid 70s, early 80s, inflation and rates took up even in a recessionary period. That's stagflation in that regard. So a lot of people are saying because of tariffs, inflation will be more sticky, but then because of tariffs, growth will slow down and be negative, and that's stagflation. It won't look like the 1970s where you had double-digit inflation, rise up in 3 different stages. Oil would have to, you really need a supply shock, and then that supply shock forces wages to go up and inflation goes up. But we had unbelievable labor force growth. Housing was booming, by the way, in the mid to late 70s. So it's a completely different backdrop, but you could get a shorter version if some people are talking about stagflation in that regard, that the trade war tap dance, it leads to lower economic growth. It keeps inflation higher than what the Fed wants. It won't look like the 70s, but in that short duration form, you could think about stagflation in that way.
So, I think back to a year ago, or maybe even longer than that, but not that long ago, we were talking about soft landing for the economy. And now, we never talk about that. What we're talking about is like, are we going into a recession? Are we not? What's the difference there? And what is the Fed thinking about that specific thing about recession?
First of all, I don't even discuss the soft or hard landing anymore. That was a 2024, 2023 story. We have to go back into a normal economic cycle period now. And of course, the variables have changed. So it's very simple. If the US goes into a recession, it goes into a recession. Forget soft or hard landing. This trade war tap dance started in 2025. So this is what we're dealing with. This is what the Fed has to deal with. This is by choice. This is not by anything forced into this. So we have to look at the economic cycle in a much different way, and we have to adjust to it. This is why we did that podcast on November 7th, 2024. What can or can't happen, right? Mortgage rates can't really go to 8% in this environment because the builders will start to go into recession even deeper. If you want a trade war tap dance, you're going to have markets act crazy again. That's what's happening, right? We technically had a correction. So Yeah, the soft hard landing I kind of threw away. We're just going to look with the cycle, and I think that's where we have to keep an eye on data. This is why we framework the job market on you can get higher unemployment rate, lower job growth. Does that break the labor market, or does that force rates to go low enough to maybe boost the housing market, which clearly now we know the White House is 100% on getting that because they think they can market that as a victory. Again, oil prices falling, mortgage rates falling, those two things I believe in their surveys were number 1 and 2. And then they push that and they go with that. And we've seen it again. I think I've seen Trump market it 3 times. Pulte, the head of the FHFA, talked about it as well. So you can see this is the game plan here.
So if you're out there, you're running a business, what do you make of this? How do you make your decisions not knowing what's going on here?
If the Fed is dealing with this chaos, it's very hard for business people to deal with this as well. So we're seeing this in a lot of other indexes where business people are like calling in the White House. Hey, what are the rules here? I don't know. And this is one of the reasons why we did that podcast on November 7th. What happened back then in 2018-19 is business investment went to zero because people didn't know the rules, right? So right now we're starting to see people, what are we going to do? Well, so clarity from chaos can clear that up quickly. So that's why I'm hoping that in April something gets cleared up, because doing this for like 4 years, I mean, people are going to get sick of it, right? Back and forth, tariffs on, tariffs up, so something has to change. You either do a deal like you did in 2019, or you go full blown tariffs and just take the consequences, right? So I think if you're asking me how are business, every business person is up in the air right now. So and again, this is why it's somewhat frustrating, because the president has talked about regulations and doing all these things for businesses, and then he does this. And this is just how he's always been a tariff person. So in that context, you get maybe a clear advantage here, but then this. So that's why I'm hoping by April something gets, some clarity on it. And this is why I've talked about recently. If you go in the trade war tap dance early, you have to pull the trigger, because everyone's just going to think you're not going to do something, and we always see these updates. So by April, we should get something, and then they got to just go with it. They can't, like 5 months from now, go back into it again and just, people need to have a little bit of more clarity to push forward, to make choices out there, and then we go with that.
So you're talking about April because April 2nd is the implementation date of a lot of these tariffs. So we will know for sure, are they going on, or are they going to get potentially pushed back? But it feels like that is a hard date, a hard deadline in a way that we haven't seen so much before this.
Yeah, and that's more the reciprocal tariffs. And the U.S. is such a unique economic superpower, and a lot of these other countries are just very small compared to us, and they make us like, how their economy runs is selling into us. So it'll be interesting to see what the final outcome of that in April.
So last time in the 18-19 period, how did it end up with tariffs? Like what was his trajectory there? What did he do? How did it end?
So the economic data started to get worse, and eventually Trump made some deals. And then when the deal talk was starting to get firmed up, the economic data started to get better. I know this because I wrote about this all the time, that, I think people mistook not reading the positive data lines toward the second half of 2019. Housing data picked up. And then the early part of 2020, the first 2 months before COVID hit, jobs beat estimates, retail sales were up, ISM service sector was up, PMI manufacturing are up, housing permits are up. That is expansionary in every single cycle post World War II. I wrote the article. I still have all those charts up there and everything. I remember that. So there was clarity, and that clarity brought things back in line. So we'll see. We'll see if this is just kind of January to April trade war tap dance, and then they go with it. But again, for me is I really want to see how the Fed and with the dot plots and everything, and how they all look at this. And of course, Bowman, who got a promotion, she's now, okay, I know we're focusing on inflation, but I'm going to focus on the labor market and the economy. So interesting times, Sarah. Interesting times.
Interesting times, which, keeps you busy, keeps me busy. So we'll take it. But I do feel for people of all different kinds trying to make decisions in that sort of lack of clarity. So hopefully we get some more, at least from the Fed next week.
Yes, yes, and again, the Q&As are going to be really key because you're going to get you're going to get some interesting questions going out, and I wonder if some reporters going to ask them. It seems like the White House is very keen on getting mortgage rates lower for the American people. Do you feel that you, as Federal Reserve presidents, are out of touch with society? That just getting mortgage rates down to 6%? The White House wants it, the American public want it, but you guys are still in the Neil Kashkari phase. You can't balance the economy, 6% mortgage rate. So it'll be interesting if there's a housing component in out here. And we kind of picked up on this early. We're like, oh, you're talking caps? Oh my God, they want lower mortgage rates, and nobody, but now they're like, whoa, lower mortgage rates. And Pulte come out yesterday and did the same thing. So.
And I would, listeners, if you want more information on that, Logan wrote up an article about the Fed versus the White House on mortgage rates. Go look that up. It's great. He goes into detail. There are charts. Let's just say there are always charts.
Always charts, man.
Which are hard
chart
to do.
Daddy's got charts.
Hard to do on a podcast. So, Logan, thanks for joining us, and we will talk to you again soon.
Pleasure, Sarah.